Hey there, welcome. This is Scott Chris with a mortgage update for December of 2017. I'm sure you guys have seen all the tax reform going here and there and everywhere, but we wanted to really focus on how that's impacting home buyers and homeowners in 2018. So we found this great article, and the link will be posted down below with the journalofaccountancy.com. Um, and uh, and anyway, we want to kind of share with that information with you. So, but of course, guys, I want you to know that everybody's tax situation is different. So definitely, take this with a grain of salt and just kind of take it as an idea, but definitely consult with your tax professional to see which deductions are really truly available to you in your specific financial situation. Because it is not our goal to give tax advice, but give you information to ask your tax professional how this applies to you. So here's our interpretation. The interest deduction, not a huge change on this. They were talking about either completely removing it or reducing it to 500,000. Now the current interest deduction for a primary residence is 1 million. But they are going to lower that down to 750. Now this has impacted very little, very few of our clients. So these are clients with primary residence at 750 or lower. I did have a person ask me to say, hey Scott, well, is that combined with investment properties and everything else? I can tell you this. We review tax returns on a daily basis, and many of our clients, our investors, have way more than $1 million in outstanding mortgages, and they are still writing those off. Okay, how? Because you have your Schedule A, which is where you write off your primary residence, and your Schedule E, where you write off your real estate owned. So it's our interpretation that that will stay the same, meaning that your primary residence you can write off down to 750,000 now. But if you have other investment properties, you can still write off that interest separately, which would be excluded from the 750,000 in your Schedule E. So you can exceed with investment properties. Okay, so hopefully that clears it up, but definitely check with your CPA. Home equity lines, they were deductible. Sorry guys, now they're not tax deductible anymore. So that's pretty black and white. As far as property taxes, to our knowledge, there wasn't a cap before, but now there's a $10,000 cap. So between state, local, and of course property taxes, they're capping the total amount of deductions to $10,000. So again, most people's property taxes don't go up to $10,000 a year. So this will have a very little impact, if any, to very few of our clients. So that was actually pretty good news. And the best news, I believe, was capital gains from the sale of a primary residence used to be excluded. Obviously, there's more details to this tax guideline, but they did not change this in the reform. So the capital gains from a sale of a primary residence, if you lived there for 2 out of the last 5 years, it appears to still be excluded with many or all of the same rules. So anyway, this is a quick breakdown of how the new tax reform has impacted real estate. And so anyway, if you have more information, or if there's something that you found that maybe conflicts with what we're saying, please leave those comments down below. We're learning all of this as it comes out, and we'd love to hear from you guys. Anyway, that's it for now. Have a Merry Christmas, and thanks for watching. Take care. Bye-bye.